Investing is often misunderstood. Many think it is about chasing quick gains or predicting the next big trend. But true investing is not about speed. It is about patience. It is about understanding the world of money and, more importantly, understanding yourself. This book is a guide for anyone who wishes to become an intelligent investor. It is not just about stocks or bonds. It is about a mindset, a way of thinking, and a disciplined approach that lasts a lifetime. You will learn how to think like an investor, not a speculator. You will learn how to measure risk, find value, and make decisions calmly, even when the world panics. We will start with the foundation, the right mindset, because no amount of financial knowledge can replace the clarity and discipline of the mind. Once your mind is prepared, we will move to understanding the flows of money, the patterns of markets, and the ways to act with intelligence. Each chapter builds upon the last, creating a roadmap from mindset to mastery. As we begin, remember this. The journey is not about winning every trade. It is about learning, growing, and creating lasting wealth. So take a deep breath, quiet your mind, and prepare to step into the world of intelligent investing. Next, we will explore the mindset of an intelligent investor. This is where your journey truly begins. Chapter 1. The mindset of an intelligent investor. The first step in any journey is understanding where you are starting from. In investing, the journey begins not with money, but with the mind. Before you can navigate markets, analyze companies, or understand trends, you must understand yourself. The mind is the most important tool you will ever use. It shapes your decisions, controls your emotions, and ultimately decides your financial destiny. An intelligent investor is calm when others panic. They are patient when others rush. They think long-term while the crowd chases short-term gains. This mindset is rare, not because it is complicated, but because it is difficult. Human nature often pushes us toward greed and fear. We want to buy when prices are high, because everyone else is buying, and we want to sell when prices are low, because fear overwhelms reason. The intelligent investor learns to rise above this instinct. Patience is not waiting. It is making thoughtful choices and trusting the process even when immediate results are not visible. The market rewards patience, but only to those who can remain disciplined in the face of uncertainty. Discipline is the foundation of intelligent investing. Without it, even the most brilliant strategy will fail. Discipline allows you to resist the temptation to follow the crowd blindly. It allows you to remain rational when the world becomes emotional. Another key part of the mindset is humility. The market is bigger and smarter than any single investor. No one can predict every movement or control every outcome. Accepting this truth is liberating. It allows you to focus on what you can control, your own decisions, research, and actions. By focusing on your circle of control, you reduce risk and increase clarity. Long-term thinking is the next pillar. The intelligent investor knows that wealth is built slowly, brick by brick. They do not chase trends or look for instant rewards. They understand that time is a powerful ally. When you combine knowledge, discipline, and patience, time multiplies your efforts into compounding results. This mindset allows you to see opportunity in volatility rather than danger. Where others see chaos, you see potential. Emotional stability is essential. Markets rise and fall in cycles. News headlines may cause fear. Rumors may tempt you to act impulsively. The intelligent investor learns to observe without reacting. They make decisions based on logic and analysis, not emotion. They understand that short-term noise is not relevant to long-term value. Finally, the intelligent investor cultivates curiosity and a love of learning. Markets, economies, and businesses are constantly changing. The investor who stops learning will fall behind. Ask questions, read widely, challenge assumptions. The mind that is open to learning will see opportunities that others overlook. This mindset is the foundation for everything that follows. Without it, analysis will be incomplete, decisions will be impulsive, and mastery will remain out of reach. With it, you are prepared to enter the world of investing with clarity, confidence, and purpose. In the next chapter, we will explore the power of financial awareness. Understanding your own money habits, tracking spending, and recognizing where your money goes is the next step. Because before you can invest intelligently in the world, you must first invest intelligently in yourself. Chapter 2: The Power of Financial Awareness. Before you can invest intelligently in the market, you must invest intelligently in yourself. Financial awareness is the foundation of every sound investment decision. It begins with understanding where your money comes from, where it goes, and what it is doing along the way. Many people think that earning more money solves all problems. But without awareness, even a high income can vanish into debt, waste, and poor choices. Awareness is the key that opens the door to control, planning, and freedom. The first step in developing awareness is tracking your spending. Every dollar you spend tells a story about your priorities. Where you choose to direct your money is a reflection of what you value most. Do you spend on immediate pleasure or on things that build a better future? By observing your spending habits honestly, you can begin to make intentional choices rather than reactive ones. Awareness also includes understanding your financial strengths and weaknesses. Are you naturally disciplined, or do you struggle with impulsive decisions? Do you understand basic concepts like saving, investing, and interest, or do you rely on guesswork? Knowing your own tendencies allows you to create strategies that fit your personality. It also helps you identify areas where you need guidance or education. The intelligent investor treats money as a tool, not a goal. Money is a means to an end, not an end in itself. It allows you to build security, freedom, and opportunity, but it requires conscious management. Financial awareness is about taking responsibility for your financial life instead of leaving it to chance or emotion. Another part of awareness is understanding the difference between assets and liabilities. Assets put money into your pocket. Liabilities take money out. Many people confuse the two, thinking that expensive cars, large houses, or luxury items are assets. In truth, these often drain your resources rather than build them. The intelligent investor focuses on acquiring true assets that grow over time. Awareness also extends to understanding risk in your personal finances. Do you have emergency funds for unexpected events? Do you rely too heavily on credit, or are you prepared for downturns? Being aware of your vulnerabilities allows you to protect yourself before you face a crisis. This proactive approach is far superior to reacting in panic after problems arise. Finally, financial awareness is a habit, not a one-time exercise. It requires regular check-ins, honest assessments, and adjustments as life changes. The intelligent investor reviews income, expenses, and investments frequently. They do not ignore problems, hoping they will disappear. Instead, they confront reality and make deliberate choices to improve their position. By cultivating awareness, you gain control over your financial life. You begin to see patterns, opportunities, and risks clearly. You learn to separate wants from needs, emotions from logic, and impulses from strategy. With this foundation, you are ready to step into the next stage of intelligent investing, understanding risk, safety, and the language of value. In the next chapter, we will explore the concept of risk and how safety is created in investing. Because without understanding risk, no amount of awareness or discipline can protect your wealth or guide your actions effectively. Chapter 3: Understanding Risk and Safety. Risk is the shadow that follows every investment. There is no investment without some degree of risk, but not all risks are equal. Some risks are calculated, manageable, and even opportunities in disguise. Other risks are hidden, unpredictable, and dangerous. The intelligent investor learns to recognize the difference. They do not fear risk. They respect it. They prepare for it. The first step in understanding risk is accepting its reality. Risk is not something you can eliminate. It is a natural part of markets, economies, and human behavior. Ignoring risk or pretending it does not exist is a recipe for disaster. Instead, you must acknowledge it, measure it, and act with awareness. One of the most important tools for managing risk is diversification. Do not put all your money into a single company, sector, or asset type. Spreading investments reduces the impact of any single failure. It is not a guarantee against loss, but it increases the likelihood of stability and long-term growth. The intelligent investor sees diversification as insurance against the unknown. Another crucial concept is knowing your own risk tolerance. Some people are naturally cautious. Others are bold and willing to accept larger swings in value. Understanding your temperament is essential because emotional reactions can create financial mistakes. If you invest beyond your comfort level, fear or greed will likely lead you to make poor decisions. Safety in investing is not achieved by avoiding all risks. It is achieved by taking risks that you understand, that you can afford, and that offer rewards in proportion to potential loss. This is why knowledge is a shield. The more you know about a company, a market, or an economy, the more intelligently you can assess risk. Ignorance is the biggest threat to your wealth. The intelligent investor also understands that timing is never perfect. Markets fluctuate unpredictably. Waiting for certainty is waiting forever. Instead, you act with prudence, using analysis, preparation, and your margin of safety to reduce potential harm. It is a balance between caution and opportunity. The concept of safety is closely linked to the margin of error. Never risk what you cannot afford to lose. Leave room for mistakes, unexpected events, or sudden changes in the market. This margin is your guardrail, your protection against the unexpected. Without it, even a small mistake can turn into a catastrophe. Finally, the intelligent investor views risk as a teacher. Every market drop, every unexpected loss offers a lesson in patience, strategy, and humility. They do not react with panic. They reflect, analyze, and adjust. Through this process, risk becomes not just a challenge, but an opportunity to grow stronger and wiser. Understanding risk and creating safety are the foundations of every investment decision. Without them, profits are fragile, and mistakes can be devastating. With them, you navigate markets with confidence, clarity, and resilience. In the next chapter, we will explore the language of value. Because to act intelligently, you must not only understand risk and safety, but also know how to identify true worth beneath the noise of prices and emotions. Chapter 4. The Language of Value. Investing is not about chasing the latest trend or following the crowd. It is about understanding value. Price is what you pay. Value is what you get. The intelligent investor knows this distinction and builds decisions around it. Markets often confuse the two, and emotions make the confusion worse. When prices soar, people assume value has increased. When prices fall, they assume value has decreased. But value is not determined by emotion or opinion. It is determined by the underlying strength and potential of an asset. To understand value, you must look beyond the surface. Examine the fundamentals. Analyze earnings, growth potential, and the competitive advantage of a company. Consider the quality of management and the clarity of strategy. A strong company may face temporary market setbacks, but its value remains intact. Conversely, a hyped company may rise in price, yet its true value may be fragile or overstated. The intelligent investor does not follow the crowd blindly. They seek opportunities where the market undervalues true potential. They buy when others are fearful and sell when others are greedy. This requires patience and courage because it often means going against popular opinion. It also requires research and discipline because acting on impulse is the fastest way to destroy wealth. Understanding value also means understanding time. Value is revealed over the long term, not in daily fluctuations. The market may misprice assets for months or years, but over time, true value tends to emerge. This is why the intelligent investor focuses on long-term fundamentals rather than short-term speculation. Another key principle is the concept of intrinsic value. Intrinsic value is the true worth of an investment based on its earnings, assets, and growth potential. It is not influenced by temporary hype, news, or market emotion. By comparing intrinsic value to market price, the intelligent investor can make informed decisions. If the price is significantly below intrinsic value, it is an opportunity. If the price exceeds intrinsic value, it is a warning. Value investing is not easy because it requires independence of thought. It requires resisting social pressure, media narratives, and herd behavior. Most people react to market movements emotionally, but the intelligent investor reacts rationally. They have a framework for decision-making that prioritizes reason over emotion. Finally, understanding value is a lifelong skill. It applies not only to stocks or bonds, but to every decision involving money. From buying a house to evaluating a business idea, value is the compass that guides intelligent choices. Once you master the language of value, every investment decision becomes clearer, more confident, and more aligned with your long-term goals. With a deep understanding of value, you are prepared to take the next step. In the following chapter, we will explore the two sides of investing, defensive and enterprising. Because knowing how to value an investment is only part of the journey. You must also understand the style, approach, and temperament that suits your goals and personality. Chapter 5. The two sides of investing, defensive and enterprising. Investing is not a one-size-fits-all activity. Different investors have different goals, skills, and temperaments. Understanding your style is essential to success. Broadly, intelligent investors fall into two categories: defensive and enterprising. Both approaches can lead to wealth, but each requires a different mindset and effort. The defensive investor prioritizes safety, simplicity, and steady returns. They are cautious and prefer low-risk investments that require minimal maintenance. Their goal is not to beat the market, but to preserve capital while achieving reasonable growth. Defensive investors often choose diversified funds, bonds, and high-quality companies with stable earnings. They avoid speculation, leverage, and complex strategies. Discipline, patience, and consistency are their strongest tools. The enterprising investor, on the other hand, seeks higher returns and accepts a higher level of effort and involvement. They are willing to research companies in detail, analyze financial statements, and monitor market trends regularly. Enterprising investors may invest in smaller, undervalued companies, turnaround opportunities, or specialized sectors. They understand that higher rewards come with higher risk, but their knowledge and preparation give them an edge. Both approaches share a common foundation: value and safety. Even the enterprising investor does not chase hype blindly. Even the defensive investor does not settle for mediocrity. The difference is in effort, focus, and tolerance for activity. Neither approach is inherently better than the other. The key is alignment with your temperament, goals, and available time. Choosing your approach requires self-awareness. Are you naturally patient and cautious, or are you curious and willing to dig deeper? Do you have the time and energy to research and monitor investments, or do you prefer a more hands-off approach? Answering these questions honestly helps prevent mistakes born from misalignment. Another consideration is flexibility. Your style may change over time. Early in your career, you may lean toward enterprising strategies to accelerate growth. Later, you may shift to defensive investments to protect accumulated wealth. Intelligent investors understand that style is a tool, not a fixed identity. Consistency is more important than cleverness. Many investors fail because they switch strategies too often or chase trends outside their style. The intelligent investor commits to a path that fits their goals and temperament. They follow it consistently, adjusting only when personal circumstances or market fundamentals change. Both defensive and enterprising investors benefit from discipline and emotional control. Fear and greed affect all investors, regardless of style. The defensive investor must resist the temptation to chase excitement. The enterprising investor must resist the temptation to act impulsively. In both cases, decisions are guided by analysis, patience, and adherence to principles. Understanding these two sides of investing is essential before making choices. It allows you to match strategy with personality and goals, reducing stress and increasing the likelihood of success. The intelligent investor does not imitate others blindly. They define their own path, rooted in self-awareness, knowledge, and patience. In the next chapter, we will explore the margin of safety, a concept that protects all investors, whether defensive or enterprising. Because even with the right style, understanding how to protect your capital is critical to long-term success. Chapter 6. The Margin of Safety. The margin of safety is one of the most important concepts in intelligent investing. It is a principle that protects your capital, reduces risk, and allows you to act confidently even when uncertainty surrounds the market. At its core, the margin of safety is about buying below true value. It is a cushion that absorbs errors, unexpected events, and market fluctuations. Without it, even a well-researched investment can lead to losses. With it, mistakes become opportunities to learn rather than disasters. Imagine walking on a narrow mountain path without guardrails. One misstep could be fatal. Now imagine the same path with a solid guardrail on the edge. The risk is still present, but the chance of a serious mistake is greatly reduced. In investing, the margin of safety is your guardrail. It allows you to navigate uncertain markets with confidence. To apply a margin of safety, you must first understand the intrinsic value of an investment. This requires analysis of earnings, assets, growth potential, and risks. Once intrinsic value is determined, the intelligent investor buys at a price significantly below that value. This difference between price and value is the margin that protects against error. It ensures that even if the market moves against you, your potential loss is limited. The margin of safety also applies to personal circumstances. Invest only what you can afford to lose without jeopardizing your life or security. Do not overextend with loans, leverage, or speculative bets. A strong margin of safety in personal finances is just as important as in investments. Many investors ignore this principle because they are tempted by high returns or market hype. They buy overpriced assets hoping for quick gains. When the market turns, they panic and sell at a loss. The intelligent investor resists this temptation. They value safety over short-term excitement. They know that long-term success depends on protecting capital first and growing it second. The margin of safety also encourages patience. You may have to wait for opportunities where prices fall below intrinsic value. This waiting period is not wasted time. It is a strategic pause that allows you to act decisively when the opportunity arises. Impatience leads to overpaying, reducing, or eliminating your margin of safety. This principle is universal. It works for defensive investors seeking stability and enterprising investors seeking higher growth. Both groups benefit from having a buffer that absorbs error and uncertainty. Even the best analysis can be wrong. The margin of safety ensures that errors do not become catastrophes. Finally, the margin of safety cultivates humility. It reminds you that no one can predict the market perfectly. It encourages preparation, discipline, and respect for uncertainty. It turns fear into strategy and uncertainty into opportunity. By understanding and applying the margin of safety, you gain confidence to make investments that are rational rather than emotional. It is the key to surviving market volatility and thriving over the long term. In the next chapter, we will explore understanding market behavior. Because knowing how the market moves, reacts, and fluctuates is essential to applying the margin of safety and making intelligent investment decisions. Chapter 7. Understanding market behavior. The market is like a living creature. It breathes, reacts, and moves with moods that shift constantly. It rises in optimism and falls in fear. It can appear rational one moment and irrational the next. Understanding market behavior is essential for the intelligent investor because it allows you to act with clarity, not emotion. Human psychology drives most market movements. Fear and greed are powerful forces. When everyone is buying, prices rise, often beyond true value. When everyone is selling, panic spreads, and prices fall below intrinsic value. The intelligent investor does not follow the crowd blindly. They observe, analyze, and act according to principles rather than emotions. Markets operate in cycles. These cycles are not perfect or predictable, but they are consistent over time. There are periods of optimism, overconfidence, and rapid growth. There are periods of pessimism, despair, and decline. Understanding this rhythm allows investors to see opportunity where others see danger. It allows them to remain patient and disciplined rather than reacting impulsively. Another key aspect of market behavior is volatility. Short-term fluctuations are normal. They can create fear, but they are often irrelevant to long-term value. The intelligent investor focuses on fundamentals, not headlines. They understand that temporary noise does not alter the true worth of an investment. Overreaction is a hallmark of human behavior in markets. Prices swing far beyond reason when emotions dominate decision-making. The intelligent investor uses this to their advantage. When the market undervalues an asset out of fear, they see opportunity. When the market overvalues an asset out of greed, they exercise caution. This counterintuitive approach is one of the most powerful tools in investing. Patience and observation are essential. Markets will test your discipline constantly. There will always be stories, rumors, and speculation that tempt you to act impulsively. Resist them. Study the patterns. Look for signals of underlying value rather than temporary hype. Market behavior is also influenced by broader economic and social trends. Interest rates, inflation, technological shifts, and global events can all affect prices. The intelligent investor pays attention to these forces but does not become overwhelmed. They integrate this knowledge into decisions rather than reacting emotionally. Finally, understanding market behavior requires humility. No one can predict every movement. Even the most experienced investors are often wrong in the short term. The intelligent investor accepts this uncertainty and builds strategies that protect against error. They do not try to control the market. They control their decisions and risk. By studying market behavior, you gain insight into human psychology, economic trends, and the forces that drive prices. You learn to act with reason, patience, and confidence rather than emotion. This understanding prepares you to take advantage of opportunities safely and effectively. In the next chapter, we will explore the power of compounding, the quiet force that turns disciplined investing and patience into extraordinary long-term wealth. Because understanding the market is only useful if you know how time and consistency multiply your efforts. Chapter 8. The Power of Compounding. Time is the most powerful ally of the intelligent investor. Compounding is its magic. It is the quiet force that multiplies effort, patience, and reinvested gains into extraordinary results over the long term. Albert Einstein once called it the eighth wonder of the world. Those who understand it earn its rewards. Those who ignore it pay the price of impatience. Compounding works when gains are reinvested. Every return you earn becomes a new source of growth. This is why the intelligent investor does not focus solely on short-term gains. Instead, they think in years, decades, and even generations. Small, consistent actions over time produce results far greater than sporadic, risky attempts at instant profit. Consider a simple example. A modest investment, if left to grow and compounded annually, can increase many times over the years. The secret is not a high return or perfect timing. The secret is consistency, patience, and allowing time to work. Compounding rewards those who start early, even with small amounts. Time is a force that turns seemingly insignificant choices into monumental outcomes. The power of compounding is not limited to money. It applies to knowledge, skills, and habits. Daily learning, disciplined saving, and careful investment decisions all compound over time. This is why the intelligent investor values not just financial returns, but also personal growth and experience. Every improvement in understanding or skill multiplies your capacity for wise decisions. Patience is the companion of compounding. The market will fluctuate. Returns may seem slow at first. Many investors give up too soon, thinking they are not making progress. The intelligent investor understands that time is essential. Even periods of stagnation are part of the process. By holding, reinvesting, and maintaining discipline, compounding transforms modest beginnings into extraordinary results. Compounding also protects the investor from impulsive behavior. Chasing quick gains, reacting to fear, or following hype interrupts this process. The intelligent investor avoids these distractions, understanding that the steady growth of compounding far outweighs the illusion of instant profit. Another important aspect of compounding is the impact of losses. Losses reduce your capital and slow the compounding process. This is why risk management and the margin of safety are essential companions to compounding. Protect your capital, and compounding can work its magic. Neglect it, and even a good investment may fail to achieve its potential. Finally, compounding teaches the value of starting early. The sooner you begin investing, learning, and developing financial habits, the greater the reward over time. Do not wait for perfect conditions. Begin now, even modestly. Time will magnify your efforts beyond what seems possible today. The power of compounding is the bridge between knowledge, discipline, and wealth. It turns intelligent decisions into extraordinary outcomes. It rewards the patient, the disciplined, and the consistent. Understanding this force allows you to focus on what truly matters. Steady, thoughtful investing over years, not instant success. In the next chapter, we will explore emotional control and the investor's heart, because no matter how well you understand compounding, your emotions can either amplify its effect or destroy it. Mastery over feelings is essential to make time and compounding work in your favor. Chapter 9. Emotional Control and the Investor's Heart. Investing is not only a matter of knowledge, analysis, or strategy, it is also a matter of the heart. Emotions play a powerful role in financial decisions. Fear and greed are forces that have moved markets for centuries. They tempt even the smartest investors to make mistakes. Understanding and controlling these emotions is essential to becoming an intelligent investor. Fear is the most common emotion that leads to poor decisions. When markets fall, fear spreads like wildfire. People panic and sell at the worst possible moment. They lock in losses, often abandoning good investments out of anxiety. The intelligent investor does not deny fear. Instead, they recognize it, analyze it, and act calmly. Fear becomes a signal, not a trigger for rash action. Greed is equally dangerous. When prices rise rapidly, the desire for more can cloud judgment. Investors may overpay, chase trends, or ignore risks in the hope of quick gains. The intelligent investor resists this temptation. They remember that market highs can be temporary, and that true value must guide every decision. Greed without discipline leads to losses. Discipline transforms greed into opportunity. Emotional control is learned through self-awareness and practice. The intelligent investor observes reactions to market events. They notice when anxiety or excitement is influencing decisions. They pause, breathe, and consider facts before acting. This habit of reflection prevents impulsive choices that could undermine long-term goals. Patience is a key aspect of emotional mastery. Markets do not move in straight lines. They fluctuate, sometimes unpredictably. The intelligent investor accepts this rhythm. They do not demand instant results. They allow time and analysis to guide decisions rather than emotion. Another important practice is detachment. Investing is not a personal battle. It is not about winning, losing, or proving intelligence. The intelligent investor separates ego from decision-making. They focus on the facts, value, and strategy rather than pride or fear of embarrassment. Experience also strengthens emotional control. Each market fluctuation, gain, and loss is an opportunity to learn. The intelligent investor reflects on past mistakes without judgment. They extract lessons and apply them in future decisions. This builds resilience and confidence, which are essential to navigating uncertain markets. Finally, the intelligent investor cultivates a mindset of long-term perspective. Emotions are powerful in the short term, but over time, rational decisions dominate outcomes. By focusing on principles, value, and safety, rather than daily market noise, investors gain clarity. The heart becomes a servant of strategy rather than its master. Emotional control is the bridge between knowledge and action. Without it, even the best strategies fail. With it, patience, discipline, and compounding work to their full potential. The intelligent investor learns to observe markets calmly, act with reason, and use emotion as a guide, not a command. In the next chapter, we will explore building a portfolio with purpose, because controlling emotions alone is not enough. You must also structure your investments to reflect your goals, priorities, and long-term strategy, turning knowledge and discipline into meaningful results. Chapter 10. Building a portfolio with purpose. A portfolio is more than a collection of stocks, bonds, or assets. It is a reflection of your goals, values, and strategy. The intelligent investor builds a portfolio with purpose. Every investment is chosen deliberately, not randomly. Every position serves a long-term objective. Without purpose, a portfolio is like a ship without a rudder, directionless and vulnerable to storms. The first step in purposeful investing is defining your goals. Are you seeking long-term wealth, income, or preservation of capital? Do you have specific milestones, such as retirement, education, or a major purchase? Clear goals provide focus and allow you to make investment decisions that align with your life plan. Next is diversification. A well-diversified portfolio spreads risk across asset classes, industries, and geographies. Diversification does not guarantee profits, but it reduces the impact of any single loss. The intelligent investor balances growth-oriented investments with stable, income-generating assets. They also consider alternative investments when appropriate, but only after careful analysis and understanding. Asset allocation is equally important. How much of your portfolio is in equities, bonds, or cash depends on your goals, risk tolerance, and time horizon. You may adjust allocations over time as your circumstances and market conditions change. The intelligent investor makes these adjustments deliberately, not impulsively. Rebalancing is a key part of portfolio management. Markets move and allocations shift. Without rebalancing, a portfolio may drift away from its intended strategy, exposing you to unnecessary risk or reducing potential returns. Regular reviews and adjustments ensure that your investments continue to reflect your goals and risk tolerance. Purposeful investing also considers the quality of each investment. Select assets that have strong fundamentals, sustainable growth, and competent management. Avoid chasing trends, hype, or speculation. Quality builds resilience. Quality enhances compounding over time. It is the backbone of a portfolio designed to last decades. Another critical element is patience. A purposeful portfolio is not about short-term gains. It is about consistent, thoughtful decisions that compound over years. Investors may face market volatility, economic changes, or unexpected events, but a well-constructed portfolio provides stability and confidence. The intelligent investor also aligns investments with personal values. Purposeful investing considers more than returns. It considers ethics, social responsibility, and long-term impact. This alignment increases commitment and reduces the temptation to act impulsively during market swings. Finally, documenting a strategy is essential. Write down your goals, allocation plans, and criteria for buying or selling. A documented plan serves as a guide during emotional moments. It transforms intuition into discipline. A portfolio built with purpose is not static. It evolves with your life, goals, and market conditions, but it always remains intentional, disciplined, and aligned with your principles. In the next chapter, we will explore learning from mistakes, because even the most purposeful portfolio will face challenges. Understanding errors and adjusting accordingly is a critical step toward mastery in investing. Chapter 11. Learning from mistakes. Mistakes are an inevitable part of investing. Even the most disciplined, informed, and patient investors will face errors. The intelligent investor does not fear mistakes. They embrace them as opportunities to learn, grow, and improve. Mistakes are not failures if they lead to understanding and better decision-making in the future. The first step in learning from mistakes is honesty. Admit when a decision was wrong. Do not blame the market, other people, or luck. Take responsibility. This clarity allows you to examine what went wrong and why. Without honesty, mistakes repeat themselves. Next, analyze the mistake in detail. Was it due to a lack of information, poor analysis, emotional reaction, or timing? Did you ignore your own rules or fail to apply them consistently? Break the error into its components. By understanding the root cause, you prevent it from recurring. Emotional reflection is also essential. How did fear, greed, or impatience influence the decision? Did pride or overconfidence blind you to risk? The intelligent investor studies their emotions as carefully as financial data. Emotional awareness transforms mistakes into tools for growth. Another important practice is documenting lessons learned. Keep a journal of decisions, outcomes, and insights. Review it regularly. Over time, this journal becomes a personal guide, revealing patterns, strengths, and weaknesses. It helps you refine strategies, strengthen discipline, and enhance judgment. Learning from mistakes also involves perspective. One error does not define your investing ability. Markets are unpredictable, and even the best analysis can fail. Treat setbacks as temporary and educational. Avoid the temptation to react impulsively to losses or to chase recovery. The intelligent investor also distinguishes between controllable and uncontrollable factors. You cannot control market movements, economic events, or other investors' actions. You can control your analysis, decisions, and adherence to principles. Focus your energy on what is within your control and learn from outcomes without regret. Mistakes also teach humility. Overconfidence is a dangerous trait in investing. It leads to excessive risk, ignored warning signs, and poor decisions. By studying errors carefully, the intelligent investor remains grounded and realistic about their abilities. Finally, learning from mistakes is a continuous process. Markets evolve, industries change, and new opportunities arise. Investors who stop reflecting and adapting risk stagnation or failure. By committing to lifelong learning from both successes and errors, you strengthen your skills, resilience, and confidence. Understanding and learning from mistakes transforms challenges into stepping stones. It turns losses into lessons, setbacks into insights, and errors into wisdom. This practice is a key differentiator between occasional success and long-term mastery in investing. In the next chapter, we will explore mastery through patience, because even when you have learned from mistakes, wealth and wisdom grow slowly and require sustained discipline and long-term commitment. Chapter 12. Mastery through patience. Patience is the secret that separates ordinary investors from intelligent investors. Knowledge, analysis, and discipline are essential, but without patience, they often fail to produce results. Mastery in investing is not about acting quickly or predicting every market movement. It is about steady, deliberate, and consistent action over long periods of time. Time amplifies good decisions and diminishes poor ones, but only when accompanied by patience. The intelligent investor understands that wealth grows slowly. Markets do not deliver instant success. Even the best investments require years of compounding, reinvestment, and steady growth. Patience allows you to stay the course, even when the market fluctuates or doubts arise. It transforms temporary setbacks into opportunities for reflection and strategic action. Patience also helps you resist impulsive decisions. Fear and greed are constant companions in the investing journey. Without patience, you may sell in panic during a market drop or buy recklessly during a surge. The patient investor observes, analyzes, and waits for the right opportunity. They act when conditions align with value, safety, and their long-term goals. Another aspect of patience is long-term vision. Short-term results are often misleading. A portfolio may underperform temporarily, or a promising investment may take time to bear fruit. The intelligent investor focuses on the bigger picture. They measure success not by daily or monthly fluctuations, but by cumulative growth over years and decades. Patience also encourages consistency. Regular investments, disciplined saving, and adherence to a strategic plan accumulate over time. Even small contributions, when sustained, create significant wealth through compounding. The impatient investor may abandon a strategy too early, missing out on the powerful effects of consistency. Mastery through patience requires humility. You cannot control markets, predict every movement, or avoid all mistakes. Patience allows you to accept uncertainty while acting prudently. It turns waiting into a strategic tool rather than a source of frustration. The intelligent investor also cultivates emotional endurance. Market cycles include highs and lows, optimism and fear. Patience allows you to navigate these cycles without losing discipline or perspective. It prevents temporary setbacks from derailing long-term plans. It transforms volatility from a source of anxiety into an environment where opportunities can emerge. Learning from history, is part of mastering patience. Markets have risen and fallen countless times, yet disciplined investors have consistently benefited over the long term. By studying past cycles, investors gain confidence to hold steady during uncertainty. They see that time, combined with rational decision-making, consistently rewards discipline. Finally, patience is not passive. It is an active form of waiting, guided by analysis, discipline, and strategy. It requires regular review, reflection, and readiness to act when opportunities align with your principles. It is the balance of vigilance and restraint, action and observation. Mastery through patience transforms knowledge, discipline, and experience into sustained financial wisdom. It allows the intelligent investor to navigate complexity, uncertainty, and market swings with confidence. By embracing patience, you convert time into one of your greatest assets. In the next chapter, we will explore the journey of financial wisdom, where all principles converge. We will see how mindset, awareness, discipline, patience, and learning from mistakes combine to create not just wealth, but true financial mastery and freedom. Chapter 13. The Journey of Financial Wisdom. The journey of financial wisdom is not a straight path. It is a continuous process of learning, reflection, and disciplined action. It combines mindset, knowledge, patience, emotional control, and experience into a cohesive approach to life and investing. The intelligent investor understands that wealth is not an end in itself. It is a tool for freedom, security, and the ability to make meaningful choices. Financial wisdom begins with self-awareness. Know your goals, strengths, weaknesses, and risk tolerance. This awareness shapes your strategy and ensures that your investments align with your values and life priorities. Without self-knowledge, even the best financial plans can falter under stress or unexpected events. It also requires continuous learning. Markets evolve, industries change, and new opportunities arise. The intelligent investor commits to lifelong education, reading, observing, and adapting. Mistakes are analyzed and used as lessons, not sources of discouragement. Every success and failure contributes to a growing understanding of how to navigate uncertainty. Discipline is another cornerstone. Financial wisdom is built through consistent action, not occasional brilliance. Saving regularly, investing according to principles, and avoiding impulsive reactions create the foundation for long-term success. Discipline transforms knowledge into results and maintains stability during times of volatility. Patience is equally essential. Time is the amplifier of intelligent decisions. Compounding, growth, and experience all require a long-term perspective. The patient investor does not chase trends or short-term gains. Instead, they focus on steady progress, understanding that wealth and wisdom grow gradually. Emotional control binds all these principles together. Fear and greed influence everyone, regardless of skill or experience. The intelligent investor observes emotions without being ruled by them. They make decisions guided by analysis, value, and strategy, rather than reaction or impulse. This control turns potential pitfalls into opportunities. Financial wisdom also involves purpose. Investments are chosen not only for profit, but for alignment with life goals, ethics, and priorities. A purposeful portfolio reflects personal values and long-term objectives, creating clarity, commitment, and satisfaction. Learning from mistakes is part of the journey. Errors are inevitable, but they become stepping stones when approached with honesty, reflection, and adjustment. The intelligent investor does not repeat errors, but uses each experience to refine judgment and strengthen strategy. At the highest level, financial wisdom integrates all these elements into mastery. Mindset, awareness, value, risk management, style, discipline, patience, and emotional control converge into a coherent approach. This mastery is not about perfection. It is about resilience, adaptability, and the ability to navigate complexity while maintaining principles. True financial wisdom is also generous and mindful. Wealth is not only for personal gain, but can be used to support family, community, and meaningful causes. The intelligent investor considers the broader impact of decisions and acts with care and responsibility. Finally, the journey never truly ends. Markets, economies, and personal circumstances change continually. The intelligent investor remains curious, reflective, and disciplined. They know that wealth and wisdom are cumulative. Each step taken thoughtfully builds the foundation for the next, creating not only financial security, but the freedom to live a life of purpose, meaning, and opportunity. By embracing these principles, you become more than an investor. You become a steward of resources, a lifelong learner, and a person capable of making wise decisions under uncertainty. The journey of financial wisdom is yours to continue, guided by discipline, patience, and clarity. Conclusion. Becoming an intelligent investor is a journey, not a destination. It is the combination of mindset, knowledge, discipline, patience, and emotional control applied consistently over time. It requires self-awareness, careful analysis, and the courage to act against popular opinion when necessary. It demands respect for risk, a focus on true value, and the practice of building a margin of safety in every decision. The intelligent investor understands that wealth is not measured solely by money. It is measured by freedom, security, and the ability to make thoughtful choices. It is achieved through long-term thinking, consistency, and the quiet power of compounding. Mistakes are not failures, but lessons. Patience and discipline turn knowledge into results. Emotional mastery allows reason to guide action, even when markets fluctuate wildly. Investing wisely is not about being perfect. It is about making informed, deliberate, and principled decisions. It is about creating a portfolio that aligns with your goals, values, and temperament. It is about learning from experience and continuously refining your approach. The journey of financial wisdom transforms not only your wealth, but also your character. It teaches humility, resilience, and clarity. It cultivates freedom and opportunity. It equips you to face uncertainty with confidence and to make decisions that serve your long-term well-being. The roadmap we have explored, from mindset to mastery, is a guide. Its power comes not from reading alone, but from practice. The intelligent investor applies these principles consistently, learns from experience, and embraces the slow, steady process of growth. In the end, intelligent investing is a lifelong journey. It is the art of turning knowledge into action, risk into opportunity, and time into wealth. It is about becoming a person who makes thoughtful, deliberate, and wise financial decisions in every moment. And with each step, you move closer, not only to financial security, but to true freedom, wisdom, and mastery. The journey begins with a single choice: to act with intelligence, patience, and purpose. Take that step today and continue walking the path of the intelligent investor.